This is your LMAX Exchange technical update for Tuesday, July 18th, 2017. Eurodollar. So this weekly chart in the euro is becoming increasingly important. We've seen a very strong uptrend in the euro in 2017, with the market now trading up into a critical resistance zone in the 115 to 117 area that has capped gains going back to 2015. And so, although we've seen an intense uptrend in 2017, risk is now building for some form of a corrective pullback at a minimum in the sessions ahead. We still need to see, however, a break back below the previous weekly low, which comes in at 113.70 at a minimum, to take the immediate pressure off the top side and suggest that this reversal could be underway. Sterling dollar. So cable has recently broken out to a fresh 2017 high above that previous high that was in place from back in May at 130.48. Again, putting that pressure towards a measured move extension over the medium term, which could even be over the coming days up towards the 135 area. At the same time, this has been a significant longer term structural shift following that breakout in April above 127.75, and it could take some more time and some more choppy trade before the market does push up towards 135. We could then see some more consolidation roughly between 125 and 130 before the market does make that move. Any setbacks that we do see again back towards the 125 to 127 area are considered to be corrective, and the market should be putting in a higher low ahead of that bullish resumption. Dollar yen. Dollar yen has been pulling back since capping out above 114. Over the past several weeks, the market has been very well capped on rallies above 114 and above 115. And so the risk now is for another pullback towards the 2017 low, which comes in just shy of 108. At this point, it would take a break above 115.50, that high that we had seen back in March, to put the pressure back on the top side and suggest that this market is ready for a more significant bullish resumption. Euro Swiss. So the recent breakout in the previous week above 110 sets the stage for Euro Swiss to break up towards a retest of the 2016 peak at 112. At this point now, it would take a break back below the previous weekly low around 109.80 to take the immediate pressure off the top side. Aussie dollar. So Aussie has been consolidating over the past several months, roughly being capped in the 78 area, and so this latest rally that we've seen up above 78 does have good reason to once again stall out in favor of a bearish reversal back down towards recent range lows, which come in closer to 70. At the same time, if the market does establish clearly above the 78 handle, maybe even above 79, it would suggest that we're seeing a longer term structural shift that could open the door for significant upside. So we're at a bit of an inflection point here, and it'll be interesting to see how the market responds above 78. Dollar CAD. Dollar CAD setbacks have been intense over the past several weeks since topping out at a 2017 high just shy of 138, and now the market has come back down over 10 big figures to trade into the 126s thus far. There is risk for continued downside towards the 2016 low at 24.61, but at this point, with technical studies severely overextended, the market should be looking to be very well supported around current levels in favor of a resumption of gains. Back above 130.15 will ultimately be required now to put the pressure back on the top side. Kiwi dollar. So the New Zealand dollar has rallied up over the past several weeks since putting in a 2017 low at 68.18, but the market is back into some critical resistance that has been capping gains over the past several months up above 73 and into the 73 to 75 area. As such, look for the market to once again stall out here in favor of a bearish resumption. We would need to see a breakdown all the way back below 72 to strengthen this outlook and accelerate declines. SPX 500. The S&P 500 broke out several weeks back to a fresh record high above 2,400, and that followed a period of consolidation between 2,400 and 2,320, an 80-point consolidation. And so the breakout that we did see several weeks back in May above 2,400 set the stage for a measured move extension of 80 points up to 2,480. And so that's where we could be headed over the coming sessions before the market considers the possibility of topping out and reversing. A break back below 2,400 would be required at a minimum to suggest that the market is topping out and to alleviate immediate topside pressure. Gold. So gold has broken back up after the market had seen an intense reversal to the downside off those 2017 highs just shy of 1300. The market has been supported into this dip ahead of 1200, and the recent breakout back above 1230 puts the pressure back on the top side and suggests we could be headed for a resumption of gains towards and above that 2017 high at 1296. A break above there would expose a retest and a measured move towards the 2016 peak at 1375 further up. Only a close back below 1200 would compromise the constructive outlook for gold.